bought my first stock in 2005, but obviously I was a child. I was just like, I like stocks. But I want to give you guys some color on what my life experience was and then what my dad told me about the 2005 to 2008 period. He was a trader in the industry, if you didn't know. So at some point, like 2007-ish, I figured like, if I look at the stock market, my dad's going to be like in a good mood. Like I'll be able to tell what kind of mood he is because, he took it home a little bit. Let's just say that. So all of a sudden I learned like, okay, like pretty quickly, like stock market goes up. Like obviously everyone's making money because you buy stocks, they go up. I bought, Apple, and I liked seeing it go up because I saw that I was making money. So I go to my dad and I'm like, one day I remember the stock market was up like 1.5%, 2%, everything green, sea of green. I'm like, Dad's gonna come home happy. And I like wait by the door. Remember when he was coming into the apartment, and I just like immediately could tell he's like in a bad mood. He's like, "Hi, Nicholas," and I just remember being like it was just like, "Hi, Nicholas," like he he was like, "Fuck." Now my son's waiting for me at the door, and at that point I realized like, Jesus fuck, like why? And I asked him, I'm like, why are you in a bad mood? And he's like, well, we're short. We're short. My dad rotated in 2005 to 2007. He was in one, two for sure, three, I believe, three different hedge funds. It was pretty like well out there, known that there were major problems, and yet it still surprised people because the market kept on going up, right? Like the Michael Burry Big Short thing, like it wasn't an understanding of like, oh shit, we have a bubble. Like people were saying and feeling that we had a bubble for like 2 years. Michael Burry was definitely very, very early in figuring out how to capitalize on it. But the idea was like, listen, like, they're going to make their way out of it. Like, there's not that much risk on banks' balance sheets, which ended up being like completely false. And the reason why I tell you that is because this private credit thing, it's an iceberg. It's an iceberg. You might see on the surface, like, okay, there's not that much private credit on these big banks' platform. But then you have to consider these are the most profitable, highest margin segments of their businesses, like the fastest growing as well. And when that's the case, then you have to worry about earnings. And it's okay, like take a step deeper, like, okay, they also have collateralized fund obligations, which is like basically they have rights to the LP stakes before the LPs do. Now, I'm not saying that this is like a banking sector issue. It's a shadow banking sector issue, actually, this private credit thing. And the way that, private credit, like you got to understand, like private equity is like their first losses. That's a almost $10 trillion market. So if we're talking about 3.5, depending on where you find the numbers, I say 3.5. Okay, well, people are like, well, max, we're going to lose 20 cents on that. It's like, no, you don't get 10% yield and only have 20% downside. That breaks the rules. Like in 5,000 years of capitalism or fucking economics, to 400 years of capitalism, supposedly, but I believe that's always been capitalism. Even in communism, it's just capitalism with really strange rules. Capitalism is just competition. Private property. You try to get rid of private property, you end up with, political capital, and you end up with, black markets. So I just think it's all capitalism. But 5,000 years of financial history, you don't get 10% yields with only 20% drawdown. So I'm like, listen, EBITDAs are overvalued by 30%. 20% of that's bullshit. Okay. So that you could easily take a 20% haircut to all the PE companies and then the loan to values. What do? Right? If you take a 20% haircut just on the adjusted EBITDAs, you come to a loan to value that goes up, let's just say 20%. Because if you take a 20%, if it's 20% overvalued, it's like 16.7% that it should be down. You look at the marks on these private credit companies, they should be down 10 to 12% across the board, and that's not even giving like the worst case scenario for software. Software is 20% of all private credit loans outstanding. I was shook. I thought it was like 7%, but I guess I was just looking at like what some of the big guys were saying, maybe, Ares and Carlyle, like maybe they're doing a good job. at 7% software exposure. But what I'm saying is like, take the software exposure, write it down 70%, because duh, there's going to be no exit. Like there's just no fucking way for, the majority of those companies. Sure, there's going to be some infrastructure plays that will work. Write that off 70%. Then, because also no recovery value, even in some of these other companies. But let's talk about some of the other companies, okay? That's where the 20% EBITDA cut is, and I think the multiples are 30% too high. So people are like, how are you saying it's 50% overvalued? That's how. And I think it could be, higher in some cases. You're talking about, pest control at 18 times EBITDA. What the fuck are we talking about? Really, what the fuck are we talking about? That should be 9, maybe, because it's like stable, steady cash flow, 9 times EBITDA. Okay? And again, fake EBITDA. We're talking about Panera at 20 times EBITDA. We're talking about Core Power at 15 times EBITDA. Like the car washes, yeah, we remember how much I go off on car washes. Like I think you could find probably 30% of companies that you'd be like, this should be 50% lower. It's 100% overvalued. So when you go through it and it's like, okay, private equity is going to take a big white B. Private credit's going to take a big white B, and they thought that was, or they were pitching that as safer than IG bonds. A lot of these are going to be fire sold. It's on insurance balance sheets. Downgrades happen. There's insurance capital calls. That goes into, what's it called, receivership, when the regulators step in. But then you have these guys get so greedy that they went into 401ks. It's one thing to be Silicon Valley Bank and go into receivership, and people forget about it. People complain and then they forget about it. But we're talking about a bailout of people's 401ks where they can see the loss in their account. They log in, see the loss. That is when you get regulations. So that's when you get regulations that, you can't have permanent capital. That's bullshit. And that should be the rule. There should be no such thing as permanent capital. The fact that these PE companies, like Apollo, co-found, buy, gather assets, offer the highest yield, and then go into the private credit markets and make a spread from, this really risky lending that they say is like the safest lending of all credit. Like literally they say it's safer than IG bonds. Maybe they don't say it's safer than treasuries, but like, fuck. Safer than investment grade corporate bonds? Get the fuck out of here. That's going to hurt their PEs, right? We talked about the bank's PEs. Now we're talking about private equity PEs. That the private credit side is like where they make the majority of their money. Look at the asset growth there. And all of these private equity companies, look at their PEs. So we're looking at a PE equation, but then you have to understand, like, if you have downgrades, capital calls, receiverships, there's going to be a sale of these private assets, as well as you have a chilling effect. Look at Cliffwater, 7% redemption. So you have a chilling effect across the industry. There's not money flowing in. With private credit and private equity, when you chill it, there's already no exits. We're already having credit crunch. What if there's less money going to it? In fact, there's redemptions. Do you see how that's a major issue? And that can expand to other sides of credit. But the reason why I told you the story I started with is because it may take a while. It may take a while. Don't get in over your skis. Right now, cash is paying 4%. Might not be a bad idea to have 25% cash. You don't have to run a long short strategy. You don't have to, be super genius Michael Burry. Michael Burry was losing money for a long ass time and he was basically schizophrenic. That's what happens when you get too bearish. So I want to tell you the whole picture. I've written it all up. You can read it on Substack. It's still on paywall. You can see it on Twitter. However, assess the risk, understand the whole picture, make a mental model. May happen, probably will happen in my opinion, but you don't want to get over your skis bearish. There will be a time to be a vulture and get great companies that are being thrown out with the bathwater. That's what I'm hoping for, honestly. I hope you enjoyed my story.